everybody. Luke Gromen, founder and president of FFTT, Forest for the Trees. For our two things that grabbed my attention recently, update, or doing on a Monday night tonight as opposed to Sunday. Apologize that missed y'all last night. So I'm going to jump right in as usual. The first thing that really grabbed my attention was this article we retweeted from FT Alphaville last week, which looked at the United States Treasury market, U.S. dollar reserve status, through Dutch disease, a lens of Dutch disease. And for the uninitiated, Dutch disease is it's what's referred to as the sudden discovery of reserves of a high-value commodity. It can cause basically hyper-focus on the production of that commodity to the detriment of the rest of the economy. And it happened when Netherlands had a large natural gas discovery in the 50s. You've seen it in a number of different commodity-centric emerging markets. And the fascinating thing to me was that the article looked at it in a manner that we have looked at it, which is from 1999 to 2014, by far and away the United States' single biggest export were U.S. Treasury bonds. We exported about $667 billion per year of Treasury bonds for 15 years. And that was, number two was less than 1/3 the size of our exports, and it was like all machinery and components. Just to give you a sense of how much more treasuries we exported than everything else. And so it leads to this recognition that when you look through this lens, this is why Washington and Wall Street did so much better than flyover country for those 15 years. And that's fine. It was a policy choice. There were winners, there were losers within that policy choice. There were trade-offs. However, it was all fun and games until an adversary got big enough to basically have the discipline to underspend, save those dollars up, and then start buying, stop recycling those treasuries. And of course, that's China as well as some other emerging markets. And so this framework is critical to understand because it highlights the point that unless the United States is willing to cede the reserve status of the dollar as currently structured, and by that they're going to have to allow a neutral reserve asset to be valued much higher against the dollar. I personally think it'll be gold or partially gold or SDR gold combination. But the bottom line is that unless the U.S. government's willing to do that, China's going to keep playing the game they're doing. They're going to keep winning. And so that's the first thing that grabbed my attention. The second thing that grabbed my attention just this afternoon is former Goldman Sachs alum and New York Fed head Bill Dudley said that Fed hikes may be back in play as soon as the second half of this year. And everybody's looking at this very skeptically, and I don't think you should look at it skeptically. When you take a look at what the analysis we've done, we've talked about a number of times on Twitter and in public appearances, the U.S. stock market effectively is the economy, and particularly through the consumption link, through the tax receipt link. And so, of course, you saw surprisingly bad December data for consumer spending, housing, a whole number of consumer-facing metrics. The same month we had the worst December in 87 years in the stock market. Fast forward a month, 2 months, we've seen some rebound in the January consumer data as we've seen this very strong rebound in stock market. So if you continue to see just this sort of relentless march higher in equities, I would not be surprised if hikes do get put back on the table and the data do start to turn. And that may surprise some people. So it's still early days. I don't want to get carried away with it. But I've read things where, hey, if the Fed pauses, they've never started re-hiking after they've paused. And I suspect that that's probably true, that people have done that analysis. My only retort to that would be, if I had a nickel for every time in the past 10 years that the Fed did something that they've never done before, I'd already be retired. So just keep an open mind about it. Let's see how the data comes in. But that is a very interesting comment to me, particularly coming from the former head of New York Fed and Goldman alum. So I'm going to, before I jump into some questions from last week, just a quick heads up. We're having a paid live webinar happening on March 26th. It'll be limited seats. And check it out at FFTT-LLC.com. We'll have a slide deck we'll run through talking about 3 different issues that are discussed on our website, and then we'll open up the floor for questions. And last time we did this, last quarter, floor was open for 2 hours. It was a great discussion and a lot of fun. So check it out if you're interested. I'm going to jump into a couple questions. The first question, it's a long question, but the bottom line to it is what is if the euro has an issue before the dollar, could that help the dollar? And absolutely. That's the case. If Deutsche Bank has a problem or something like that, as some have speculated they could, yes, absolutely. The United States needs somebody to recycle those treasuries that we were just talking about, to sterilize them. And so the biggest surplus countries in the world are China and Germany. And China's not recycling them anymore. Germany stopped recycling them in any real way, sterilizing them in any real way, in the late 90s after the formation of the euro, or early 2000s after the launch of the euro. So if the eurozone did break up, then in theory that would create some incremental treasury buyers. It would buy time. It would, in theory, drive capital flows. But I say in theory because I do think it's underappreciated, this sort of generic capital flow analysis from the eurozone. If there's a problem in the eurozone, there's going to be capital flooding from the eurozone to the U.S. And I think, broadly speaking, that's true. But what I don't know how to net against, or how to think about how to net against, is there's this big transatlantic carry trade going on. You can borrow in Germany at basically zero and bring it to the U.S. and buy treasury bonds. We're going to set aside the cross-currency basis hedging effects for the moment. But the point is that if there is a problem there where the capital's already here, and that's ultimately the point. And I don't know how much more capital would come. That is an analysis I've not done. And I've not really seen anybody else do. It's just the generic. The capitals go from here to from there to here, and so it would be something that we'd need to look into more deeply. The second thing is just asking about the dynamics around paper contracts and physical deliveries, and why do I say the price of gold doesn't really matter, or the fundamentals of gold don't matter until they matter. And the issue is that gold the gold market, the gold price you see is a gold liability. It's a futures contract. It's paper set. It is a cash settled futures market, and it's a cash settled futures market on a monetary asset. And so, when I say monetary asset, you can see the definition of a monetary asset is driven by stock to flow ratio in commodities. So, take the oil market, for example, is a highly levered, big paper market attached to it, but it doesn't have the same problem because the stock to flow ratio for oil is, say 1.4 times when there's too much inventory, and 1.2 times stock to flow when inventories are tight. And so the way to think about that is, if it's a shell game, there's 1.2 to 1.4 shells for every P hidden under the shell. So the fundamentals of the oil market cannot get far away from the paper price because you got to store the stuff and it gets used. Contrast, and that's the same story with copper. It's the same story with grains, etc. Contrast that with gold. The stock to flow ratio is 65 or 70x. So 65 stock to flow ratio. That means there's 65 shells for every P. So there's a lot more leeway, and that difference between 1.2 to 1.4 stock to flow ratio for oil versus 65 for gold, that's a monetary asset. A high stock to flow ratio is a monetary asset. And so when you have cash settlement of a monetary asset, people say is the gold market manipulated? Who knows day to day? But what the real discussion that should be had is the manipulation is a cash settled futures contract on a monetary asset. Once that is set up, you remove price discovery from the actual physical market by and large to the cash market. It turns it into a balance sheet contest, and trust me, none of us have the biggest balance sheet. So I will jump from that. Last question, what are the real world implications of a Fed balance sheet at a big number, 6 trillion or more than that? Ultimately, I think the Fed's going to have to get back into the game, and I think when they do, it won't be good for the dollar, but the path to that does matter. So that ultimately, though, I would read an increasing Fed balance sheet as dollar negative and risk asset positive, all else equal. Hi, Michael. U.S. corporate buyback blackout peak into early April. Is it significant? Possibly. When you look at some of the data showing that equity inflows have continued to decline throughout, or equity outflows have continued to decline throughout this entire equity rally, which is unusual. One inference I've seen made from that, and I've not dug in deep enough to really understand all the moving parts, but one inference I've seen made from that is that corporate buybacks are really helping drive the equity market, and so to the extent that that there is a blackout where broadly speaking corporates can't be in buying their own stock back, then it's something to watch for sure. Let me see. Hi, Michael. Palladium running out of shells. The stock is low. Fascinating that gold bull markets follow palladium. Yeah, it's a perfect example. Palladium has a very small futures market, if one at all, and it's used for something, right? So it's a lower stock to flow ratio. And look, I don't think the EPA would appreciate you stapling paper palladium contracts to the bottom of your car as a catalytic converter. I don't think that that's probably going to help the exhaust of your car. And so you got to have the real thing. And when you look at some of the supply-demand dynamics, where's palladium sourced from? A lot of it's being sourced from Russia, if I'm not mistaken. You're seeing some supply-demand fundamentals playing out there. So I think it speaks a little bit to both. I don't think there's as robust the paper market, but I also think that there's it's probably a lower stock to flow ratio because it's being used in a real industry. All right, looks like we're pretty much out of questions at this point. So I'm going to jump, and if in the meantime, like I said, check out FFTT-LLC.com if you're interested in jumping on to our webinar next week. It'll be March 26th, which is Tuesday night, and there'll be more details on our website. But in the meantime, everyone have a great night, and we will talk to you soon. See you Sunday night, everybody. Take care.